Hello traders, Gary Wagner here. Just after 12 noon in Honolulu, 6 o'clock in New York. It is Thursday, last day of the month, April 30th, 2020, and this is the daily report for gold and silver. We saw sharp declines in both gold and silver today, and platinum and palladium did trade higher. As far as gold is concerned, we've had an immense drawdown this week to the tune of approximately $50. That being said, gold closed up approximately 6% on the month. The only thing that I can say about this week's activity in gold is there's absolutely a disconnect between the fundamentals at play and how gold is reacting to that fundamentals. That being said, it did affect our bottom line. We will talk about our trade, which we were stopped out of. But first to the price board. Gold pricing did sell off sharply today, currently down over $20 at $16.9310 after trading to a low today of $16.8750. That did stop us out effectively at $16.98, while we are up on the year and up on the month in terms of trading recommendations. That certainly doesn't temper today's loss. Nonetheless, we will discuss that when we pull up our technical studies. Spot gold sold off even harder today, currently down $25.40 at $16.8480, and silver sold off by about 1.63% to $15.06.5. Platinum and palladium did track higher. Platinum closed up $6.20 at $805.80, and palladium gained about 1.2%, a $23 gain, taking that precious metal to $19.40. We had a falling U.S. dollar, but that wasn't enough to really affect gold or silver, as they both sold off sharply on the day. Dollar index at 99.02, and equities sold off at the same time, with the mini S&P down 58 points, the NASDAQ composite down about 0.33%, and lastly, the Dow Jones Industrial trading off by over a full percent, 1.17% at 24,345.72. Traders, I am truly baffled to see gold sell off as sharply as it did today, especially breaking below a key level of support, which was sitting at roughly $1,700 per ounce. I felt that that level would hold. It did not. The trade that we put on yesterday was based upon fundamentals at play in the market, and that was the Federal Reserve and the ECB being extremely accommodative, turning the printing presses on, so to speak, devaluing their currencies, which of course is bullish for gold. The dollar did go lower as we expected. However, the selling pressure that we saw in gold, I believe, was not warranted based on the fundamentals, but rather on traders pulling profits at the end of the month. So traders, while I am still extremely bullish long-term on gold, it is undeniable that this week we saw gold give up a substantial amount of value. That being said, the support levels that we will now look at are below $1,700, with the first one coming in roughly at $16.81. That is a 50% retracement. The retracement of 50% is a short-term retracement going from $15.75, the bottom of this doji here, up to this year's high at $17.88. Below that is what I call a Fibonacci harmonics, and a harmonics is when we have two different data sets giving us roughly the same price point, and that of course gives that price area much more strength, and that comes in at around 1660, the 38% retracement of the much larger data set, starting from 1451 up to 1788, and that correlates with the 61.8% retracement at 1656. So this is a critical line in the sand as far as I'm concerned, and the market absolutely needs to hold that. Below that is 1648, and that's a key area also because that is the 50-day moving average. We will remain flat with no active trades in gold or silver. We're going to let the dust settle as we go into the end of the week tomorrow and see how the precious metals react in trading next week. This has been Gary Wagner, wishing you as always good trading. I'm sorry I wasn't able to deliver that to you on this trade. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.